Markets selling off badly again today. Our own Stuart Varney speaking to Secretary of the Treasury Steven Mnuchin, who had a little blame on why the markets are going down. Let's go to it.
Do you think the market reaction was overblown to the Fed's move yesterday?
I think the market reaction is completely overblown. And, if you look at the U.S. growth versus Europe versus the rest of the world, the U.S. is still going to grow significantly higher. You look at a slowdown in China and the emerging markets. So we continue to see, when I speak to businesses, I still see a tremendous investment dollars coming into the U.S., people investing in the U.S. And I also think you're going to see a bunch of rebalancing. The bond markets have rallied significantly. You look at where the 10-year is. I think you're going to see rebalancing out of bonds into equities at these levels.
I got a theory that part of this volatility is the result of all this computer trading, algorithms. Are you with me on this?
I am completely. I think that with the advent of computerized trading, which has such a big part of the market now, combined with the Volcker Rule, where you can't have market makers commit capital, you just have much bigger moves in both directions. And I think clearly you have a situation here where the market has overreacted to the Fed's comments, and you see program trading taking over.
So, Michael, everything's great, the market's fine, the economy's strong, and it's all the program's fault. What's your take on that?
Oh, where do I begin? Well, let me begin by saying this. I'm not going to sit here and point fingers at high-frequency trading or algos, but I will say Secretary Mnuchin said something interesting a few days before that, where he said something to the effect of, this is all about market structure, and in 2019 we need to address this. Fact of the matter is, markets have become more volatile, more whippy. I said in my note to clients the other day, we live in the whippy age, where there's just a lot more movement. And look, that goes in both directions. We see it in the way up with the FANG stocks and how they act. We've seen it in the NASDAQ in the way up. We saw it in some of the cannabis stocks and the way those acted. I'm giving you examples. Tesla, we see volatility in that name. The fact of the matter is this. Look, Mnuchin's old firm, Goldman Sachs, back when I was a head trader at a hedge fund, I could call the guys at Goldman Sachs and say, hey, I got 1 million Pfizer for sale. They'd buy it from me on the wire. Now you get some 25-year-old kid at a place, and they put it into one of these algorithms, and it gets chopped up, and market information and discovery just doesn't exist anymore, and things fly around. As someone who used to trade customer orders, I babysat 50,000 shares of a very supposedly liquid stock all afternoon. So he's onto something saying it's market structure. That's not the whole answer here, though. That's part of it.
Hey, Carol.
Michael, I love the fact. I love the fact that he's blaming the millennials. It's the 25-year-old problem. Everything is about the millennials. The high-frequency trading obviously affects intraday moves, but over longer periods of time, that should all play out. I think there's a bigger issue here in terms of the Fed dependency and the fact that the market is so crazy over the fact that we've raised rates another 25 basis points. When we started this exercise in 2007, rates were at 5.25%. We are nowhere near this. If they had come out and said we're taking a pause, it would have sent a signal saying that they didn't have confidence in the strength of the economy. So it was really a no-win situation. I think that the market should have priced in the fact that they were going to do it. Maybe that we get some pauses coming into next year, but we want a Fed that is independent. We want one that is data dependent, and the fact that they have confidence in the economy should be a good thing.
Carol, whatever Jay Powell and co did, they were between a rock and a hard place. The market probably would have sold off anyway, because in the, we have quantitative tightening going on. We have interest rates going up. Arguably, we don't know how much, trying to find that neutral rate. But on top of all of this, we have a trade dispute, arguably trade war with China, and now companies are trying to exist in both. Also questioning how long can a bull market run. I remember the word was synchronized global growth back in the beginning of the year. And then it was, no, just the U.S. is the place to be. And now it's like a synchronized global slowdown. It's everybody's feeling this pain.
Yeah, here's what I'm worried about. Very simply, you have oil crashing, the 10-year yield coming down, everything at new yearly lows, and Powell and Mnuchin, arguably the two most important money men in the world, are not listening to what the market's saying and have this nonchalant devil-may-care attitude that everything's going to be just fine, while the market's got a bullhorn yelling and screaming at them. And I think that's part of what's going on with the markets on this latest leg down.
Yeah, I think Gary's got that right. Look, I don't think Mr. Mnuchin did himself any favors this morning. If you're going to blame computerized trading when it goes down, then I guess you got to give him credit when it goes up, right? I didn't hear him doing that. Look, there's a lot of things going on making the markets, making investors incredibly cranky. But here's the good news. What nobody's paying attention to, there is no bidding going on in the market.
There's no reward.
Well,
There's no reward to own it.
But why that's good news? Come the first of the year, you could see the bidding kicking in again.
That's a good point.
That's just it. What is this really about? Okay, we have slowing growth, and even the U.S. is showing slower data here. Europe and emerging markets have been in the mud all year, frankly. They just haven't been viable. But the U.S., now the data's starting to slow down. And frankly, markets going down has the wealth effect. And that's going to start affecting the data. On the 31st and then right after the new year, we're going to get that Chicago PMI and ISM manufacturing. You think purchasing managers are in a good mood to fill out a survey when their 401ks are going south?
But you're supposed to be in a good mood now. Santa Claus rally.
Unfortunately, it's not happening. It's not working.
One of those years.
Look, my point is this. There's a lot of pain out there right now, and pain begets pain. When you have a day when the stock market's up, but oil's down 7%, don't tell me that fund managers are not getting hurt by that. And that's why you're going to see days like this.
You want to know what's going on here?
What's
hang